And welcome back to the vlog. Today we will be continuing on this book here, day trading. Today we will be continuing on this book here, Day Trading by Justin K. So if you've been following along, that's dope as fuck. This is really like, I haven't been perfect in this process, but this, like, recording myself reading these books has been like, it has helped me to stay consistent, the most consistent I've ever been in terms of feeding myself like organized knowledge like this about the market and day trading. And it's so cool because like I literally can go back and I can just like play a video and I can take notes. I can remind myself of certain rules or certain things that I should be doing or whatever at any given time. So for me, this is a really important part of my trading diary and my trading experience that I will always be able to go back and look at. So really valuable to me, really important to me. And if you're benefiting from it as well, then that's really dope to me. So anyway, we'll jump right in. We are starting on chapter 3, trading psychology. Okay, so chapter 3, trading psychology. There are many skills that day traders must possess. These skills range from reading charts to calculating risks, though nothing is quite as important as having the right psychology. After all, the majority of short-term trades are dictated by emotion rather than logic. The evidence of these dynamics is clearly seen in the volatility that follows an earnings miss or a brewing economic crisis, instead of a quick and simple one-time revaluation of the security in question. Arrogance. The financial markets humble everyone over time. Sometimes investors or day traders experience a streak of success and become arrogant. In the end, their overconfidence will be the cause of their downfall. The market's boom-bust cycle reflects these dynamics as investment banks and hedge funds take on excessive risk only to lose everything eventually, even to the point of requiring a taxpayer bailout. Despite the numerous lessons furnished by past experience, the underlying human psychology persists and history repeats itself. The U.S. housing bubble is just one example. As banks were willing to take on greater risks, credit became increasingly easy to access. The subprime mortgage crisis brought the market back to reality, and credit began to retract as banks looked to reduce their risk and exposure to the market. These tendencies are known among psychologists as overconfidence bias, which means people tend to have greater confidence in themselves than is warranted. Take the following by example. By definition, only half of market participants can be considered above average at any given time. Yet a 2006 study of 300 professional fund managers found that 74% thought they had delivered above average performance, with an additional 26% calling themselves average. Obviously, it is impossible for these results to be accurate. A related psychological phenomenon is known as hot hand fallacy. People who have experienced success in a previous event believe they have a greater chance of success in the future event. In the context of day trading, traders may increase their trade size after past successes, as they believe they are more likely to experience further success. Their past performance, of course, has nothing to do with future performance, and this fallacy could amplify losses. Day traders should avoid arrogance and keep their biases in check. The best way to do so is to eliminate these emotions from the process by following a specific set of rules when trading. Another way to avoid these problems is to objectively look at performance on a regular basis and pick a single benchmark for comparison. For example, a trader may seek to beat the performance of the S&P 500 or reach his own present target returns. Rule bending. The single most important part of day trading is following rules, since those rules can eliminate the impact of emotion from the process. Nevertheless, day traders are often tempted to bend the rules in certain situations where they believe they will be able to enhance their profits. The problem with bending the rules is that one's position becomes a lot more uncertain, which means that emotion comes more into play than logic. Hey. Suppose that a trader establishes a position in a stock with the stop loss set 5% lower than the current market price. After a few minutes, the stock begins to move lower for no apparent reason and nears the 5% stop loss. The trader believes that the stock will turn around and is faced with the choice of removing the stop loss, in other words, bending the rules a bit, or letting it be triggered for a loss on the position, according to the original rules. If the trader bends the rules, he is faced with the difficult choice if the stock continues to move lower behind the 5% loss. The lack of a set stop loss at that point means that the trader could begin to experience the urge to hold the stock even more, so as to recoup the losses. In many cases, these dynamics can lead to steep losses, which, however, are entirely avoidable by sticking to the original plan rather than deviating from it by bending the rules. Denial. The impact of loss, whether it's losing a large sum of money or a loved one, can have a devastating effect on the human psyche. In order to protect themselves from the psychological impact, humans have evolved a defense mechanism called denial, which allows them to disavow or distort the reality of their situation. Denial in moderation can be useful, but when overused, it can become extremely destructive. Day traders frequently experience losses that can trigger these tendencies, especially because the losses they experience have a greater impact on their livelihood compared to traditional long-term investors or other market participants. In one study where participants gained or lost the same amount of money, the distressed experience from losing money was found to have a greater impact than the joy experience from gaining money. Fortunately, there are many strategies that day traders can implement to avoid these problems. The most obvious solution is to establish risk management rules that eliminate the possibility of large losses altogether. In addition to these techniques, day traders should keep a clear record of their trading performance over time and consistently set aside time to objectively evaluate that performance as a sort of a reality check. Aside from avoiding large losses and being cognizant of trading performance, day traders should be honest with their colleagues and family members about their financial situation. It may hurt one's ego to report financial loss, but maintaining a lie amounts to denial. Emotional trading. Few things cause people as much emotional turmoil as money does. A study conducted by Sonia Britt in the University of Kansas found that disagreements related to money were the primary cause of divorce, regardless of household income level. The impact of money on dopamine is also well established by the gaming industry, which convinces gamblers to hand over huge sums of money in small increments in exchange for the virtually non-existent possibility of receiving a large payoff. Day traders face these same emotions on a regular basis in many different ways. As we saw earlier, they must face their own emotional issues when it comes to arrogance or denial or feeling the need to make up for a large loss by making high-risk trades. Day traders must control these emotionally charged situations in order to avoid costly mistakes. Often the best way to do so is to follow a specific set of predetermined rules when entering and exiting trades, so as to make everything as automated as possible. The market itself is also largely driven by the aggregate emotion emerging from crowd psychology. In many ways, it's a day trader's job to decipher the market's emotion at any given point in time in order to profit from differences between collective perceptions and reality. News of product recall may send shares of a manufacturing stock sharply lower, but the real impact of the recall on revenue and profit may be minor, and the stock could quickly recover. These types of situations can create significant opportunities to profit. Manipulation. Some professional day traders use deceptive tactics in an attempt to improve their returns, which can make it more difficult for retail traders to compete. For instance, Athena Capital Research paid a $1 million penalty to settle SEC charges after engaging in a practice known as marking the close, whereby it allegedly manipulated thinly traded stocks in the final 2 seconds of trading. In an even more prominent case, 5 major banks, including JP Morgan Chase, paid $3.4 billion in fines for manipulating the currency markets in ways that disadvantaged some of their clients. Day traders can avoid many types of market manipulation by staying away from illiquid assets. In general, the greater the dollar volume traded each day in a given market, the more costly it becomes to manipulate that market in a meaningful way. Day traders should also shy away from stocks where they have been frequently stopped out, even if those events weren't necessarily caused by provable market manipulation. There are many cases when the effects of others meddling in the financial markets is unavoidable. For instance, the U.S. Federal Reserve attempted to influence equity prices using unconventional monetary policy in order to restore the public's faith in the market. These announcements led to increased volatility in the equity markets with a bullish skew, which may have been detrimental to day traders with short positions that were otherwise justified by poor fundamentals or technical analysis. Execution. There are few things in life more exciting than executing a day trade. Facts. In addition to the significant amount of money on the line, day traders are actively proving whether or not their intuitions were right or wrong over a period of time. The events surrounding the execution of a trade release dopamine to the brain, possibly clouding one's judgment and leading to costly errors. If a stock immediately moves lower after a trade is executed, a day trader may question his intuition and be tempted to exit the trade at a loss. This can lead to overtrading, potentially high opportunity costs, and emotional distress for the day trader. Even if a stock moves upward right after a trade is executed, a day trader may become overconfident in his ability to predict the stocks and start to overtrade. This can be even more costly as there is now a lot more money in questionable trades at risk in the market. Day traders should focus on developing their trading strategy rather than executing individuals' trades. When day traders do not let their emotions affect their decisions, the process of executing trades becomes a lot more like a business transaction than pulling the lever of a slot machine. Taken to its extremes, automating the execution of trades can prevent many psychological issues from occurring and therefore can reduce costly human errors. Okay, cool. We're going to stop right there. And then next time we'll come back for detachment and the remaining of chapter 3. Thank you for joining. See you next time.